by the very nature of it, whatever you see on a news service, they are talking about an event that rarely happens. Right. So if you're watching, I grew up in the Midwest, and so we watch the 10 o'clock news every night. And when I say we, I mean my parents watched the 10 o'clock news every night. And I wanted to stay up as late as I could. So I therefore watched it too. And growing up, my parents thought the news was important. So I thought the news was important. But actually, it's not. And it took me a long time to figure this out. But just about 2 decades ago in 1997, I stopped watching the news. Now, because of what I do, I still read and research and do a lot of work around investing and investments. So I can't help but see the news, right? So I clearly knew the Brexit vote was happening, but I kept away from reading all of the blogs and whatnot talking about how it's going to end the world. And I still see advertisements like Brexit's gonna ruin the world, 3 stocks to buy right now. I think that was from fool.com. It was something ridiculous and very hypey. But if you can learn to eliminate the noise, which is a lot of what I teach people in my world and through my research, and whether I coach them or mentor them or they buy my research or I manage their money, a significant part of what I'm doing is eliminating the noise and building strategies that can eliminate the noise. So with that, I want to talk about what is actually noise and what is going on, because there's something super amazing that's going on right now that has never happened before, but yet it's happened twice before. And I'll talk about what I mean by never happening and yet it's happened twice before, and this is the third time it's happening. Hey everybody, this is RC Peck, and this is my weekend podcast. It's episode 338, and I'm going to talk to you about something that's so interesting. What is going on with the interest rates in the world? I mean, they are accelerating to the downside. And I said a moment ago that this has never happened before. So as far as sovereign countries' interest rates, literally, I mean, I'd say race to the bottom, but they hit the bottom and they started digging. And I'll show you a few charts in a moment. So what has never happened before is this race to the bottom with interest rates, right? Germany, Japan, the UK, the US is getting pulled into it, China. The major countries in the world are all driving their rates down, as is every other country in the world, just to stay relatively competitive. So that's never happened before. What has happened before is this cycle of uncertainty, this cycle of destabilization. It happened between 1965 and 1982. It happened between 1930 and 1945. So we have two cycles that we can look back on and say, yeah, those were uncertainty cycles. Those were destabilization cycles. So the cycles have happened before, and I'm sure they were happening before that, but I only have data going back to 1896. So we only have 120 years to go on. But still, it's 120 years where a lot of things have happened. We've had 2 world wars, and when I say we, I'm talking about the United States. Right? We've had a president assassinated, a president impeached. We've had a major leader assassinated. That's MLK. We've gone through inflation, deflation, disinflation, stagflation. We've had Republicans run the government. We've had Democrats run the government. We've had pretty much every situation we've had that we're having today. Now, each time we go through one of those destabilization cycles, it looks different, right? 1930 to 1945 looked different. 1965 to 1982 looked different. And I talk about this in my one training that I called the diversification myth. I show you how these destabilization cycles can greatly negatively impact your money, or how they can greatly positively impact. So I found this picture and I thought it was just great for a world of negative interest rates going lower and lower and lower. And oh yes, I'm pretty sure, I actually don't know what language, I could have looked it up. Maybe Dutch, maybe German. It doesn't matter. It's probably almost for sure European, which makes it even better. So let's look at some price charts here, guys. Okay, here is the yield. This is the yield on the Japanese 10-year bond. So you give your money to the Japanese government, okay, and they're going to give you back less of your money each year. In fact, they're going to keep 22 basis points. So the red horizontal line is at the 0 line. And you can see that in 2016, the Japanese government yield, the 10-year bond yield, crashed. I could say this probably has crashed through the 0 interest rate line, and it is just continuing to accelerate to the downside. It is now down to negative 22 basis points. Basically, the Japanese government, they are the bond market in Japan. They are buying up all the bonds in Japan. They're buying them up. That pushes the price higher, and it pushes the yield lower. Japan is also the major shareholder of every major blue chip Japanese company in Japan. Pretty amazing, people. So that part is we've never seen it before. The part we have seen is governments taking crazy Herculean acts because we are in an uncertainty cycle. So that's the 10-year Japanese government bond yield. I don't know where it goes. It is going lower. Will it stabilize and go sideways for a little bit and then go lower again? Probably. I don't see that as a prediction. I just see the trend. I'm looking at it with my brain. I'm a pattern recognition human. So is everybody else. That's what our brains do. Through our eyes, we look at patterns, we notice patterns, and we act on them. And this pattern is clearly saying, I'm going lower. Now, Germany wanted to be part of this. Hold on a second, guys. Ooh, excuse me. Now look at Germany. Now Germany was doing its best to stay above 0. and it did it for a while. It stayed above 0 about 13 or 14 months. And then finally it just moved right below. And what makes this so stunning is if you see this 0.1 here, that's this line right here above the red line. It really tried to stay above that. It finally broke below, tried to break out above it and couldn't, and just collapsed right below the 0 line. So now if you give the German government your money for 10 years, they'll give you back less money each year. In fact, they're going to take 13 basis points from your money each year. Pretty amazing stuff, guys. Now, Germany is the largest economy in Europe. Japan is the 3rd largest economy on the planet. We're talking major economies here, right? US is number 1, China's number 2, Japan's number 3, Germany's number 4, and the UK is number 5. So UK is a really huge economy. And look at the UK 10-year bond yield. It has absolutely collapsed. Now, I'm saying this visually, right? Because look at this fall down. All right, now this is the Brexit vote that came out for the UK to leave the EU after being in it for 43 years. But going into this, just look at the price chart. It was already falling. Even this position right here, that is that is a bullish formation here where you get kind of this handle here and this flag kind of coming up. That is a bearish move. Came down, tried to break up, and has moved down. Man, is the UK going to go into negative 10-year bond yields too? Right now, if you give your money to the UK government, they will give you back 87 basis points a year on your money. So they are still positive, but they are quickly moving to the 0 line. And I don't know how long they can stay above 0 if the largest economy in Europe, Germany, and in many ways the engine of Europe, is already negative 13 basis points. Guys, this is amazing. This was predicted many decades ago when we go into a contraction cycle, uncertainty cycle, unpredictable cycle. They're all the same thing. They have different names, but it's all the same cycle. And by the way, if you go to your big box advisor or your boutique or independent advisor and say, what are we doing because we're in a contraction cycle? Guys, these are my terms. This is not industry terms. The industry just wants you to keep your money in the market and we'll just diversify through 10 different asset classes and rebalance once a year, and we'll just compare yourself against other people doing the same. Guys, that's not going to help in an uncertainty cycle, which we are in right now. The UK 10-year bond yield is quickly heading to zero, but right now it's at 87, a positive 87 basis points. So then we go across the quote unquote pond to the US and we look at what's going on over here. We look like a bargain. Now this chart is slightly different. It has a red line on. That red line is a 200-week exponential moving average. And you can look and see from 2007 till today, it's been falling. Man, when a 200-week is falling or rising, it's really hard to get that to change and go in the other direction. You can see that between 2013 and 2014, it started rising again, but then it just moved right back down. And we're getting to, on a 10-year bond yield for the US, we're getting to the 2012, that was June, I believe it was June, late June 2012, where the yield on the 10-year bond hit something like 1.43, maybe 1.4%. And I was just like, oh my gosh, that's incredible. I still thought it could go lower. I didn't think it was going to take another 4 years. But we are almost to that time where it's going to test that 1.4%. Now, I don't know. This one's a little bit more uncertain about where it's going to move. It has stretched so far to the downside that I could see it coming up and taking a breather before it moves back down again. But if Germany and the UK and Japan continue to make their rates more and more negative, people are going to put their money in US 10-year treasuries, which means the price will go higher, which means the yield will go lower. This is pretty amazing stuff that's going on. And like I say, we've never seen this specific level or this specific type of uncertainty behavior before, but this is our third time around in an uncertainty cycle. And so we have seen heroic government intervention before, and that's what we're seeing this time. Okay, last chart for you. This is a US 30-year bond yield. If you look at it and notice the red line again is the 200-week exponential moving average. But look at this. It is at lifetime lows. Never, I don't care how old you are, how long you've been on this planet. Now, maybe if you're in your second or third life on this planet, you've seen it in a different life somewhere else. But as far as the U.S. is concerned, being formed in 1776, we have never in this country seen a 30-year bond yield this low. This is amazing. It broke below its 2015 low. It, of course, broke below its 2012 low and its 2009 low. Now, here's what's interesting. Back here in 2008, 2009, the global financial crisis was going on, and we have eclipsed that to the downside once, twice, 3 times. So we are clearly still in an uncertainty cycle. One of the things my clients love is I clearly show them exactly what to do and buy in an uncertainty cycle. We've been in one for 16 years. The average length of uncertainty cycles is 17 and a half years. The longest is 22, the shortest is 12. So we know where we are in it. Things are still moving. It is very interesting what's going on. You have to make sure your money is aligned to the market and not your self-described risk tolerance or your age. Those do matter a little bit, but what matters most is what the market is actually doing. Okay, so what is the takeaway? This is coming up in the wrong order. We are living in a negative interest rate world. It is getting more negative. So the question is, what does the best? Gold and silver do very well. Safe dividend-producing stocks do very well. And you want to refinance your home. And let me just say this. If your home is paid off, I'm telling you, go pull money out of it. Absolutely go pull money out of it, because after you take into account taxes, and even if you're retired and you're on Social Security, that will lower the actual net tax rate you pay after, net tax rate after, I'm not being clear, after you incorporate your mortgage deduction in your taxes, that rate goes even lower. And we're getting very, very close to free money. Here in Silicon Valley, it is already free money. The inflation rate in Silicon Valley runs between 4 to 6%. I usually just say about 5% here. You can refinance your home, and it's very important which loan product you put it into, but you can refinance about half of what inflation is if you take into account taxes. We are getting to such amazing times to do many amazing things with our money, and unfortunately, most people are just asleep at the wheel. Hey guys, this is just another step in helping you protect and grow your portfolio. Until next time, this is RC Peck. Hey guys, I have a service called Get a Second Opinion. I sometimes call it a strategy review or a strategy x-ray, and it is a pretty powerful thing. What happens is you and I sit down, figuratively speaking, on the phone. You show me all of your numbers, your symbols, your bonds, your stocks, where money is, what you're earning, what you're spending. And in that time, we find the biggest gap in what you're doing with your money. And I tell you what you can do to fill that gap and move forward. It is a super straightforward thing to do. You simply just call Patty. She's my operations manager. The number is right there on the screen, 650-257-0207. And you get on my calendar and we together put our focus on your money. The problem with you doing it on your own is you have blind spots, and you'll always have blind spots. It's your money. You're biased to it. You made it. You're biased to it. You will do things with it that probably is not best for your money. And to get a second opinion is one of the best ways to help your money. And I just had a couple traders who self-describe themselves as traders get a second opinion strategy call with me. And it was amazing what they got. In fact, one of them said, RC, I didn't want to do a second opinion because I always thought it was for kind of conservative long-term viewers. And he's like, look, I buy and sell about 100 times a year. I don't consider myself a trader. Sometimes I do, sometimes I don't. But I didn't realize how much money I was leaving on the table by not really getting that second opinion. And it really shifted the way how he looks at his trades and investing, and actually how he implements them and where he puts his stop losses. So getting a second opinion is super important to the growth of your money, according to the people who who do get a second opinion. Okay, guys, thanks so much. Have a great, here in the U.S., it is the 4th of July weekend, so it is a long weekend for us United Statesers. I stay away from the word American because we have North America and South America, and I don't want to own that word. But here in the United States, we're going to have a 4th of July weekend. Thank you so much for being in my world, and I will speak with you guys soon. Take care.